Are you feeling that pinch at the checkout? Does your stomach drop a little bit every single time you fill up the car? Well, you're definitely not alone. There's a real pressure building on Australian households right now. So we're going to cut through all the noise in the headlines to understand exactly what's going on, what it means for your budget, and, most importantly, what you can actually do about it. Okay, let's dive right in.
A financial shift. I mean, it sounds kind of simple, right? But the impact, it's huge. And this isn't just about numbers on a spreadsheet or some boring economic theory. No, this is about that real-world squeeze that's being felt around kitchen tables all across the country. So what's really driving this thing?
Because, that's the bottom line, isn't it? It's always about how these big, sweeping economic changes actually affect the money you've got left at the end of the week. That's the gap we're here to bridge. We're connecting that big picture directly to your back pocket.
So let's get real about this pressure for a second. It's that sinking feeling you get when you see the total at the grocery store, or when you're just watching those numbers tick up and up and up at the petrol pump. It really feels like a squeeze, and that's because it's coming from a bunch of different directions all at once.
Yeah, it's a classic double whammy. So on one hand, you've got the cost of just your everyday stuff climbing steadily, and on the other, the cost of just getting from point A to point B is absolutely soaring. And these aren't two separate problems, They are like these twin forces, and they're both working against your financial stability.
The easiest way to think about it is like this. You know that $100 note that bought a full trolley of groceries last year? Well, today, it might only get you 3/4 of that. That's inflation in a nutshell. It's kind of like a silent thief, just slowly eating away at the value of your hard-earned money and making it that much harder to just get by.
So, how do we fight this rising tide of inflation? Well, the main tool in the old economic toolkit is to adjust interest rates. But, as we're about to see, this so-called solution can actually trigger its own chain reaction of problems, especially if you're a homeowner. And look, this isn't some far-off hypothetical thing. There's a date on the calendar that has homeowners and financial experts pretty much holding their breath. A potential decision from the Reserve Bank of Australia could be the next and maybe the biggest domino to fall. This is not coming out of nowhere. As this chart shows you, rates have already been creeping up. But that potential hike in May 2026, wow, that would be a huge leap. A really sharp jump in the trend that would put just immense pressure on household budgets all across the nation. So, what does a rate hike actually do to your finances? Well, for millions of Australians with a home loan, it means a higher equated monthly installment, or EMI. And listen, we are not talking about a few dollars here. As you can see in this comparison, it could mean hundreds of extra dollars a month that you just have to find from somewhere. And this right here is the crucial point. It's a chain reaction. A higher mortgage payment means less money for everything else, for your bills, for school supplies, for savings. It puts a massive strain on the entire household budget, and it just amplifies that squeeze we talked about until it feels almost unbearable. Okay, so that's the reality of the situation. It's serious, but you know what? Just worrying about it isn't a strategy. So now let's pivot. Let's go from the problem to the solution. Let's talk about what you can do starting today to take back some of that control. Here's a simple 4-step plan to get you started. First up, you've got to track your spending. I know it might be a bit confronting, but you have to know exactly where your money is going. Second, build that savings buffer. Seriously, even a small amount put aside regularly makes a huge difference. Third, stress test your budget. Actually ask yourself, what would we do if our mortgage went up by $500 a month? It's so much better to have a plan now. And finally, look into ways to make your money work harder for you. Every little bit counts.
This is so important. The goal here is not to create fear, it's to inspire action. Taking these steps is just about being sensible, about building up your financial resilience so you're ready for whatever comes next. It's all about being proactive instead of reactive.
And ultimately, that's where we leave it. It's the single most important question you can ask yourself right now. Because this financial shift, it's already happening. The pressures are very real, but the power to prepare, to protect, and to secure your family's future is still right now in your hands.